Well, hey there. I'm Terry Sawchuk. This is Thursday, so that means it's time for 3 Minute Thursdays. I want to talk about some market activity that is taking place. So this morning, the CPI number came out, and it was a lot cooler than what the market had anticipated. Some people think it was leaked yesterday, and that's why the market started to go up. Regardless of whether it was leaked or not, the reality is by getting a CPI number that was cooler, meaning that inflation isn't as high on the recent reading, yesterday, this morning's reading, versus the previous reading. The reason this is important is because it paves the way for the Fed to cut rates. And the likelihood is that the predominant likelihood is that they'll cut rates in September, but there's a growing potential for a rate cut this month in July. And this is important because it marks a sea change. We've gone from a regime where rates had gone up and just stayed there for an extended period of time. It was the fastest rate hike in history, and rates went from near zero all the way up on the short-term rate to 5.35%. So I think what the market is kind of digesting right now is that if in fact the Fed begins its cutting cycle, it means that for short-term rates that we've hit the peak. And so the direction is going to be lower, sideways, that kind of thing. And that opens the door to add bonds back into the portfolio. So if you look at the 2-year Treasury right now, on the news from overnight, you can see that it went from 4.62 to 4.517. That's a big drop in one day. And we're certainly down from the peak. Actually, if you look at the 2-year peak, it was at 5.26%, and now it's at 4.51, which is a fairly big drop. But once the rate cutting cycle starts, who knows where the bottom is going to be? So I think it's important that we think about adding bonds to the mix. Also, just you can see the preliminary reaction is that gold started to go up, and why this is also important is because the U.S. dollar is starting to weaken a little bit. And this is critical for global trade. The dollar has been a wrecking ball, which is important because there's a lot of political pressure, I think, by countries on the United States to start cutting rates because our rates are so much higher and our currency has been so strong. It's particularly been pernicious with Japan and China, but to a lesser extent Europe also. And so I think the United States recognizes this and is somewhat kowtowing to the political pressure. And ultimately, I think the Fed wants the economy to be in decent shape because it's an election year. So this was an important sea change. This is the most significant development we've seen in quite a while. And so we will be modifying our portfolios to hopefully benefit from this sea change. So you'll keep an eye on your inbox and your portfolios again, because we'll be adding some bonds and some other things that are likely to benefit from a slightly weaker dollar and interest rates that are falling in the United States. That's going to wrap up this week's edition of 3 Minute Thursdays. I look forward to talking to you next week.